I'm, as Flora introduced me, Matthias Beer from BMO Global Asset Management. It's Bank of Montreal. We're a global asset manager with about $200 billion under management. And we've been very active in the space of looking at companies, what we typically call the ESG, the environmental social governance dimension of the risks and opportunities they're facing. Starting with the climate change issue, let me take you a bit on a journey to highlight a few points about how do you measure climate change risk, how do you measure emissions footprints, and ask a question when we from the investment side approach companies requiring data disclosure around GHG emissions, for example. What are we actually asking companies to disclose? What are we actually asking about when we say, give us your scope 1, scope 2 emissions footprint and the kind of reduction targets you might have linked to this? Let me illustrate this by highlighting this sort of broad journey from my perspective. This is sort of not a complete overview of the history of GHG KPIs that we've been using, but the broad milestones I've been looking at from my perspective. So in the early 2000s, we've seen the operational GHG emissions in the investment industry have essentially emerged on the radar of some of the investors who are looking at these risks more actively and have been used primarily as a proxy for managing climate risks in general. Late 2000s, we've seen improved data visibility. This was when the likes of Bloomberg took on large data sets and actually enabled visibility on the trading floors, basically on the fund management floors, where you had now access to a much larger set of carbon emissions data for all kinds of sector, not just the oil and gas sector. 2013, as we all know, that stranded assets concept emerged at some point and framed a lot of the debate around climate change and the oil and gas industry. And then last year, COP21 certainly reaffirmed the direction of travel, where the energy system might go, and gave some more indications around the speed of that journey. Let me link that to the kind of questions we've been asking companies and we've been asking ourselves, our fund managers, along that journey. It was in 2003, really, when I picked up the Carbon Disclosure Project here. Many of you are probably familiar with that as a platform when you first saw the kind of more comprehensive data requests for carbon emissions. And in the mid-2000s, you probably saw more investors knocking at your door saying, so what do? Start disclosing using a CDP or any other framework. We want to see KPIs such as scope 1 and 2 emissions. We want to see reduction targets. As I said before, these questions were framed quite specifically, but already at the time, the kind of questions we were asking internally were less about, we are concerned about their scope 1 emissions footprint because of potential associated costs with carbon and so forth. It's more about, we are concerned about, does this company at all start to measure something related to climate change? Is that at all an issue? Is that at all on the radar of management, that this might be coming their way? Or is it still ignored as something completely, potentially irrelevant? So again, it was a bit of a proxy issue for us to say, here are companies have good disclosure on carbon, maybe they're a bit better positioned to kind of addressing some of the trickier questions around climate change and the energy transition. Then for us, certainly it was in 2009, around that time, the growing oil sands developments that put a lot of pressure on us as investors to justify investment in companies exposed to some of the unconventional assets, and put questions on the map in terms of hydrocarbon assets. What is the difference when you talk about a company more or less exposed to some of these assets that might have a higher risk of not realizing their value or their current valuations? 2011, around that time, the shale revolution shifted some of this debate about unconventional assets to the shale space. You saw requests coming from the investor side again around fugitive methane, venting, flaring, and so forth. So all of these questions that have remained with us ever since. And then really crucially, 2013, the stranded assets concept was something where we are now starting to frame the debate on a much higher level, moving from the operational footprint to the kind of strategic question that Olaf was mentioning about, where are we actually going with the energy system? What's the speed of change we are talking about? Is it 10 years, 20, 30 years? And how should investors respond to that? So there you saw KPI requests moving from the kind of simple scope 1 and 2 to high carbon, high cost assets. And the key word of strategic business resilience. How do you measure the resilience of a company when it comes to energy transition questions? And this question of climate change and the energy transition has really come full circle. We've been pushing companies, and Peter can probably talk about it a lot. We've been bugging them for quite some time, disclose this, disclose that, we want more data. But this has come full circle back to us as well, back to the investors, because what we've seen, especially in the context of the dynamic of COP21, is pressure on investors to explain and justify how they incorporate risk metrics to measure their risk exposure when it comes to energy transition, climate change risks. And we get that pressure now from our clients, our beneficiaries, who we work for. One thing to highlight is one element, a kind of big conversation in town now is the task force set up by the Financial Stability Board. So if you're watching that space and you don't know about that task force, do Google it up. It's worthwhile keeping track of what they're doing, because they're trying to bring together basically the data producers, the corporates, the data users, the financial industry, and define more clearly what kind of disclosure framework we actually need to have a much more reliable and consistent data set to work with to analyze climate change risks and to analyze how companies are dealing with the energy transition. And what you see on the investor side, what we are using increasingly is to develop quite systematic tools that are still in their infancy and still have their limitations, but we're trying to measure more consistently across all our portfolios, equity, bonds, different asset classes. How are they potentially exposed to carbon risks? How can you measure carbon risks in our portfolio? And I've highlighted there on the right-hand side, really just for illustrative purposes, the kind of carbon intensity measures we would take to benchmark our portfolio against, let's say, a benchmark, an equity portfolio against the FTSE 100 benchmark. Just want to broaden the debate a little bit and talk about safety metrics, an area that we've been looking quite closely at, of course, and not just post-Macondo, but generally looking at the oil and gas space to understand how do we identify risk. A lot of the data disclosure that we've seen in the early 2000s has been around occupational safety data. The kind of data you see here on the left-hand side, the injury rates and so forth. And this has been used, again, like with GHG emissions, as a proxy to see, okay, it's occupational data, we know about the limitations, but it tells us something about how closely our management actually looking at that space of safety. But it's not really a good indication of who is most exposed to the next Macondo, to the next major incident, because it slips, trips, and falls. It's the paper cuts that are being tracked. It doesn't tell you anything about safety on a rig, in a direct sense, that is. So increasingly, corporates have been disclosing process safety data, the kind of tier 1, tier 2, and so forth, the kind of API pyramid many of you are probably familiar with. And we're increasingly using that data more systematically. You see on the right-hand side a report that tried to normalize the different disclosures based on million hours worked and compare different super majors you see here in terms of the process safety incidents, tier 1 process safety. And you see some gaps there, but you also see if you go beyond the super majors, you will see even bigger gaps. And that kind of data helps us then to, again, identify companies that might be more exposed in terms of their assets. If we see sort of some of the high-risk assets, companies are exposed to high temperature, high pressure wells, and look at some of these process safety incidents and then say, let's have a more specific conversation around how many incidents do you have in some of these high-risk areas. So the question again is, occupational safety is a proxy measure for safety, but it doesn't really tell you much about safety culture, about that kind of overall package of how well is a company run in terms of safety management. And increasingly, we are, as I said, looking at the kind of process safety focus, but increasingly we are also asking the question, how do you measure safety culture? What are the limitations of process safety indicators like tier 1 and tier 2? And kind of supplement that with some of the softer areas that you can talk about in in a narrative more qualitatively, but maybe there are some elements you can measure as well. I've listed a few here at the bottom of the slide. Stop work authority exercised, in your high-risk areas. How often do you feel employees empowered to actually stop work because they have a safety concern? How consistent are you in closing out safety-related measures? So that a host of additional data points you can supplement these high-level process safety data points with to really give a broader picture and tell a story about what is actually the safety culture at a company. How does it really cascade from the top all the way down to the rig floor? So to wrap up, highlighting that climate change, we've come a long journey. We've asked a lot of questions about data. And that data was often used as a proxy for a much bigger question around the energy transition. And the same about safety. We've been asking for 10, 15 years about specific data points. But again, it often comes to that larger question that is being asked: what is safety culture? What is the impact on of the energy transition on your strategy? And you working in that space and looking at reporting and requests for disclosure, it's bearing in mind that bigger question when investors ask you for data points, and making clear that also the investors who ask you are clear about the question, that bigger question. Is it something they consider? How is the data being used on their side? So the final point on the safety data to make is, as we see the industry is facing much larger scrutiny, as Olaf has been saying, about the energy transition and the industry's role it can play within that transition, safety shouldn't be forgotten, because bigger scrutiny means your license to operate depends even more on that safety component, because you just need another Macondo to happen within the context of stakeholders already looking quite closely at the industry's rationale, and that's a risk for companies to take into account.